only time that when the car is used for work, not used to get to work, does the car make you money. Because if you didn't have the car, you wouldn't be getting paid, right? Is that if the car transforms into an hourly hotel, it could make a lot of money in downtown area near or outside nightclubs. Now, as funny as that is, Dylan, people live out of their cars, and they wouldn't have a problem with living out of your car. So if they're renting your car for the night, whatever they're doing in your car, again, you're still renting it out to society. That's one of those things. Now, before we dive in, I want you guys to remember that we have a different topic for you guys every night of the week, Monday, Tuesday, and Wednesday. It's usually about business and finance information. Today's topic is going to be relatedly finance, but this is a personal development topic because people who go to work and fix their credit and find the right partner, invest in home ownership, and this is a personal life choice that will drastically impact your finance. So while Thursday, Friday, and Saturday we talk about self-improvement, this one kind of intertwines with our budget topics. So that's why we're going to be talking about the amortization today. If you stay tuned, Bra Logic, I should at some point in here segue briefly into your information about those XRPs and gold and price hikes and tokenization. I actually did the work. I did the field work, and then and the information that I dug up turned my stomach in a way that I was like, nah, I might not have to wait until Tuesday. I'm probably gonna have to throw it up this weekend, which was another reason why I was late. Because I told you I was gonna look into it, and now that I got the facts for you, I'm going to debunk yet another myth, and then I'll be able to provide you, Dylan, with a lot of comfort in some areas and a lot of disappointment in the other, because I know you told me that you had some tokens. There's some good news and bad news related to that stuff. So let's go ahead and get started with one of the biggest questions, because what if I told you the 30-year mortgage, the very cornerstone of the American dream, is actually the biggest financial trap of our current generation? Because remember, we had that topic about credit scores, and installment loans boost your credit score. So the longer the installment loan, the more it positively impacts your credit score as the loan is going down and you're making on-time payments. The longer that lasts, the better your credit score. Well, the more money coming out of your pocket also. So we're going to be talking about that. Now, you think that you're building wealth by doing this stuff. You think that you're going to make more money by spending more money. And that's not the case. A lot of people think that every $1,000 payment is another brick in your financial fortress. But what if the first 10 years you're basically just renting money, right? What if your loan balance barely moves? The hard truth is that you can feel like a tenant in your own home with the bank as the landlord. And in tonight's show, I'm going to show you guys exactly how this front-loaded interest trap works. So I'm going to walk you through the math the banks hope you never bother to look at. And then I'm going to give you the exact strategies that savvy homeowners are using to break free and pay off their homes in a fraction of the time, and saving hundreds of thousands of dollars. So make sure that you guys stick around, because what you're about to learn could change your financial lives forever. Now, we've been sold that dream of home ownership. It's more than a roof over your heads. It's a symbol of success, of stability, and the main way most people think they can build wealth for their families, because a lot of us coined that specific phrase: rent you out or buy yourself a duplex or a fourplex, live in one unit and then rent out the other units so that you essentially live rent free. You work hard, save for the down payments, forgetting that these days there are options that allows you for deferments towards your down payment as long as you ask for that going in, because not every lender has those types of availabilities, but depending on the city and state and the lender that you have, there are options where you can potentially get um, no down payments included into your loan option, or down payment assistance programs. So people don't know about this. So you're trying your hardest to gain that $30,000 towards that $300,000 house, $60,000 towards that $20,000 house, and thinking to yourself, the more money I can save up to get this house, the better my options are to getting the house, in spite of bad credit, missed payments, a bankruptcy back in the day. All of these things that's happened that you just can't change the past. If I put more money down, I'm more likely to get approved, right? Um, you sign a mountain of paperwork when you're trying to get into this house, and finally you get the keys and you've made it. You've moved in, but have you actually made it? You think I have all pass. Sorry, I'm late. Special shout out to Mike. Mike is watching the comment section. So if Mike don't get you, I will. Keep your comments reasonably appropriate and today tuned to the topics at hand. Hold on, he says, I'm in a 3%, make one extra payment a year, cut into the interest. That's impressive to say that you got in on a real estate deal at 3%. You would have potentially been picking up real estate on a regular basis and paying it off on a regular basis to get 3%. You would have to be sitting on upward of a 850 credit score, because truth be told, it's around about 7%, and even at 720, you're looking at like 4.5 or 4.6%. When you start talking about the mortgage, because the mortgage on a house, you can get 2.5% or 3% if you're a veteran. For that 40%, for that 40-year loan, it's a flat rate fixed payment loan that happens from I think Veterans United mortgage company. They'll mortgage the house for you and put you on like a 3%, which is better than the market average, but you don't usually see 3% loan offices. But Dylan said, what about squatting in a house for sale? Does it become your house? Well, squatting in a house for sale is technically considered trespassing, but people do it. If the landlord is aware, or not the landlord, the homeowner is aware that somebody is in the facility and does not trespass them off the property. Like, say, for example, a chick could know the guy who owns the house and he lets her stay in the house even though the house is for sale. Squatting in a house without vandalism would have to be the only way that you would accomplish that. And if you squat in the house long enough, you have squatters' rights in the United States, which requires the landlord to only go through the extra process of evicting you from the property, because you have the legal possession of premises, which is not ownership of the property. You don't get any money off of it. You can't rent it out. But if you've stayed there for a long period of time, like 6 months or a year, they can't just throw you out. You've established like a nomad style living in that particular location. So they just have to go through the extra legal cost to throw you out. Now, usually, at least here in Florida, a lot of houses that are under development have this green sticker on it that gives law enforcement the legal authority without the property owner's knowledge or consent to enter the property when necessary and acquire any parties that are not legally authorized to be on the property, trespass those people off the property, put them in jail if they're found back on the property a second time. And you see that stuck on the glass, and sometimes the door in most areas. Making sure so law enforcement knows that anybody who walks into a property that has those notices on them, they don't have the approval to be there, especially in the middle of the night, because the place is supposed to be vacant, right? But if nobody does anything about it, yeah, they will throw you out. Michael says, I get real estate with 0%. I mean, y'all tripping, because you know that you can't get real estate with 0% interest. There isn't an option for that. And if you have a 150 credit score, that's not going to get you anything anywhere. You won't even be able to get a phone with that kind of credit score. The squatters laws are crazy here. Okay, so 750 credit score, but interest rates were 2 and got 3. Okay, yes, now that makes sense. Back when the interest rates were around 2%, as the lowest, you got around 3% because your 750 credit score. That makes sense. But right now, the average interest rates, because the feds are being ridiculous in 2025, those interest rates are going to be looking at like 8.5% on the high end. So your best bet would be 5.56%. Some people are going to get 6. The average person is going to see 7 if you have a 720. If you have less than a 720, like a 660 or 670, you're likely to see something closer to 7.5 or 8%. And if you have a VA status and you're using a VA loan, they're offering 6%, 5.5 to 6%, unless you're doing that 40-year loan. And the 40-year loan typically comes from you missing 1 or 2 payments on your original loan and then redoing the loan and then getting that 40-year loan off of redoing a 30-year loan, and then they give you the 2.5% because it keeps you from losing your house when you can't afford to pay for your house. It is a hardship loan. It is not the standard loan. So there isn't a standard loan that exists that you can use right now, because the 40-year loan that used to be standard during COVID times, they stopped using it as a standard method. Now you have to only flop on your original loan and then use that to keep you from losing your place. So that's the issue that you have. But that works when you're changing lenders because you've already got one. So we're going to be moving forward with this, and then we're going to be trying to address how all this plays into that 50-year loan that Dylan was talking about. Well, yeah, that you want to get a house with a yard so that if in the event that they're in your house without your permission, there isn't a conversation there. It's just digging a hole in the backyard. But that's one of the reasons why you want to get yourself a suppressor, because individuals that are in your house without your permission, you bury them in the backyard, nobody heard the shots. These days, people like to go out there with a loud boomstick, and then after that scenario goes down, then they're in a situation where everybody heard it, so the police are coming to investigate the sound. So now it becomes a police investigation. It isn't an investigation if nobody reported a crime, and it wasn't a crime when you buried the body in the backyard because they were trespassing. And you don't have to call the police for that, as long as you call 811 and make sure that the hole that you dug is authorized to be dug. That's it. And you're looking at, in my opinion, it would have to be like a 10 or 20 foot deep hole. That would be the smartest dig to make, not a 3 to 6, because they go 3 to 6. But if you go 10 to 20 and then like 20 down as halfway, you want to put some stuff there that makes them change their mind about continuing digging, and then keep going. And then after you put it back in there, put you some exotic plants on top of it. That delays their ability to uproot them. 15 years later, when they start looking, they ain't looking underneath them exotic plants. But have you ever looked at your mortgage statement after months or even years of making payments on time. And some of y'all that have just felt that sinking feeling in your stomach that you've paid thousands upon thousands, maybe even tens of thousands, but your loan balance is barely budged. You find yourself asking, where is all the money going? And it feels like you're sprinting on a hamster wheel again and still going nowhere. And that isn't just a feeling, it is a calculated reality, and it's by design. The system has a name, and that is a sound that is harmless to most people: amortization. And amortization is just a process of paying off debt over time. Every payment you make is split into two parts: a part that goes to the principal, the money that you actually borrowed, and a part that goes to the interest, the bank's fees for lending you the money. He said, I would buy 1,000 carnivorous Venus flytrap plants and have them eat the bad guy. Now, instead of buying carnivorous, because that's actually very creative. That is some Dr. Evil, Mr. Goldfinger kind of ideas. And I love those ideas. But it makes a lot more sense just to have like 48 or 50 very hungry pigs in your backyard, because I think the only thing they don't eat are teeth. And then you don't have to dig a hole. Just throw it out back during mealtime. If y'all didn't know already, growing up in the South, we learn ways, because in Louisiana, they don't have a first 48 because there ain't nothing to look for. Yeah, it is extreme debt. That's why real estate is only a asset when it is utilized for capital gain. As long as you're living in the house that you're paying a mortgage on, it's not turning you a profit. The same way, as long as you're the only person using the car that you're paying for, it's not turning you a profit. On this and that's episode of First 48. Xander is going to question the logic of XRP. But here's a secret that they did not exactly advertise in big, bold letters. The whole system is deliberately front-loaded with interest. That's the part that nobody really thinks about, because we believe that the interest is spread across the payments, where half of it will go to interest, the other half of it will go to the principal. Again, imagine running that marathon where for the first 10 miles, the official made you wear a 50-pound vest. Your progress is painfully slow. You're using tons of energy, but barely covering any ground. That's your 30-year mortgage. The bank makes sure that they get paid first, as much as possible before you foreclose on the loan, and they get paid the most right at the very beginning. So let's put some real numbers to this so that you can see the trap in plain sight. For example, let's imagine a $400,000 house, which is a little bit moderately priced house. And you get a loan for a 30-year fixed rate mortgage. 7% is what we got going on right now in America. I have to be clear, 7% is just an example for the math to be simple, because as of late November of 2025, the average 30-year fixed rate is actually projecting around 6.23%, but the trap works exactly the same whether the rate is 5%, 7%, or 9%. The mechanics don't change, just the values. It's crazy. I paid $240,000 for my house in 2016. Californians moved in Tucson, drove my house up $420,000 in 10 years. Yep. All it takes is for them to take good care of the land, because your house is based on the value of the last 5 or 7 houses that's been sold near your house that is similar to your house's design. So what happens there is, if you want your property value to go up, you want other people's houses to be in good condition, and that's where you have those HOA bastards that come and tell you, micromanage you, how you keep your house, because the quality of your house dictates the quality of my house and the quality of the house next door. So when people are buying houses in your neighborhood for more than what you paid for your house, the value of your house goes up because somebody could essentially buy your house for the same price, even though your house is not for sale. A home mortgage should never be for 15 years. Yeah, marriage should never be for life either. Marriage should be for the first 10 to 15 years, and then after that, it's anything goes. When loans started coming out, when mortgages like this were coming out, it was a lifetime mortgage of 15 years because your ass was going to be dead before the mortgage was paid off in the first place. It was a guaranteed debt trap. Marriage is the same thing. Till death do us part. Most folks didn't live past 40. Midlife crisis was like 25, 30. And if you got married at 18 and you lived the full life, your marriage would have been about 15, 20 years long. Odds are every 10 years, you have 5 or 10 years, you have to renew your marriage vows because you change every 5 or 10 years, and you guys are not gonna be the same people y'all were when y'all first met. You're not going to be the same people y'all were when y'all got married. And you're not going to be the same people y'all were when y'all were in that relationship for 7 to 10 years. And the mortgage is going to be the same thing. Not too many people are going to have the same job that they had when they qualified for the loan, and they're not going to be making the same amount of money that they made when they first started on this loan. And they have to figure out a way to carry the loan, even if they get a different job, even if they're making less money, even if they get injured and they can't work as much as they used to. They just got to figure these things out. And so it's a lifetime decision. And that's going to lead into what we're going to be talking about coming soon about Trump's proposal for 50-year mortgages. He said, and if Bra is correct as to hold, I can see it. Well, he was correct about holding real estate, but he was incorrect about everything else that he said. You pronounced it Tucson. Yes, sir. I pronounced it Tucson. It's Tuscan or Tucson, but I'll pronounce it Tucson. See, it's silent. All right. So on our example, $400,000 loan is 7%. Your monthly principals and interest payments would be about $2,661, and you pay this every month. Feeling responsible, you're building equity, right? You're enthusiastic about it. And you know, when you're out there as a dude, you're making these payments on your house, you're big dog on the block, you're making like $6,000 a month. Well, probably $5,000 a month. Let's be real. You're making like $5,000 a month. You're paying, you know, $2,600, $2,700 on your house, and you've got everything else going for you. And then you go over there and talk to that chick. Oh yeah, I'm a homeowner. You know, you look stable. Look at this. Of the $2,661 that you sent to the bank, how much do you think went down towards the actual loan? What do you think? Maybe half? Maybe $1,000 of it? How much of that $2,661 you think went towards the money that you borrowed? You would not believe it. Not even close to $1,000. In 1 month, about $2,333 of your $2,661 loan is pure interest going straight into the bank's pocket. Only around $328 actually goes towards reducing that $400,000 debt. Let me say that again. You paid over $2,600 and your debt went down by less than $350. Over 87% of your first payment was just a fee to the bank. You barely made a dent. And it gets worse. Look at the entire first year. He says zero. Michael, it's not going to be zero. Because he wouldn't have loans if it wasn't zero. If it was zero. You've made 12 payments totaling $31,932. You've sacrificed and budgeted and poured nearly $32,000 into your investment, right? Your investment. After all that, your loan must have dropped quite a bit, right? Wrong. After paying the bank, almost $32,000 in your first year, your principal balance has only gone down by about $4,100. So let that sink in. You paid $31,932. Your equity from those payments increased by a measly $4,100. So you are in a pretty tough spot. And the question that you're going to ask yourself, where did the other 2,700 go? The 27, well, $28,000. Where'd the rest of that go? It vanished into the bank's profit column. It didn't build your wealth. It built their wealth. So this is the front-loaded interest trap action. The loan is set up so that in the early years, you're doing the little, small increment, tiny steps that are much less than paying only on interest. The bank gets most of the profits from you upfront, making sure that they win no matter what happens, even if you can't carry this loan halfway through. You're the one taking all the risk while your payments do very little to actually secure your ownership. And this is the hidden truth of the standard mortgage. And it's why many homeowners feel like they're spinning their wheels, perpetually broke. So if your first year was shocking, get ready. We're about to look at the gears that grind away your wealth for decades. Now, the bank's secret playbook is the amortization schedule, the giant table of numbers that you got at closing. Most of us probably ignored. It lays out every single payment you'll make for 360 months. On that schedule, you'll see the same thing, $2,661 payments listed over and over and over again. But the column next to it tells the real story. The interest column and the principal column. At the beginning, the interest number is huge and the principal number is tiny. Month after month, the interest portion slowly shrinks and the principal portion slowly grows. The key word here, slowly. This brings us to a milestone most homeowners don't even know exists, the crossover point. This is when your payment finally starts working more for you than for the bank. The moment the amount going to principal finally takes the amount going to the interest over. It just completely flips and starts becoming more towards principal and less towards interest. On a 30-year loan, when do you think it happens? At 5 years or at 10 years? When do you think it happens? When you start paying more towards your principal than you start paying towards your loan. So I can understand that, especially since if you default, the bank still wins. Exactly. So on our $400,000 loan at 7%, you will make 216 payments before you hit that crossover point. That is 18 years. So for 18 solid years, the bank gets the majority of your money from every single payment for nearly 2 decades. More than half of your payments isn't building your equity, it's building the bank's profits. So you have to be in your home for almost 20 years before your payments really start to make a dent. The same way you have to own a Tesla for 20 to 25 years before it starts paying for itself, unless you're renting it out. Because the money that you save on gas and repairs is offset by the money you spend on that $15,000 battery that's not covered under your insurance. Well, it's only covered under the warranty for the car for the first certain number of miles or certain number of years that you have the car. And then after that, you're probably going to have to trade it in. But when you think about a $150,000, $200,000 car, and then you're going to have it for 5 years, the warranty is only going to last you for 3 years. The battery is only going to last you for 2 years. So you might get a free battery one time under the warranty. And then the second battery, you're going to have to trade that car in before that battery goes out. Because otherwise, you're going to have to spend $15,000, which is a Nissan Versa. The price of a brand new Nissan Versa to replace the battery in your Tesla. I don't know. Now, think about this devastating fact, because data shows that the typical American homeowner stays in their home for about 12 years, not 20. Do you see the trap? It's not genius, really. It's not for us to say that we're going to go and grab this and we're going to make ourselves rich by buying ourselves our first house. But everybody is born and raised to believe that home ownership is where you need to be. Home ownership is where we want to be. The bank knows that you're not likely to stay in this house for 30 years. Whether you die of natural causes, whether you divorce, whether you foreclose, you're not likely to be in this house for 30 years. Less people stay in their houses for more than 12 years than people that successfully pay off their loans, unless you're in real estate flipping houses on a regular basis. So they created a system that collects the most interest from you in the first 10 to 15 years of the loan. You live in the house, make payments for a decade, and decide to move. You sell, pay off what you still owe, and what you're left with now, not much more than the down payment and a tiny principal payments that you've made towards the loan. Then what happens? You take that little bit of equity and roll it into a new house with a brand new 30-year mortgage. The same way that you're forever paying extra money to lease a car under ownership expectations when you're financing it, the same way that you're paying extra money to lease a cell phone under ownership payments, is the same thing that you would be dealing with mortgaging a house until you sell and mortgage another house. The trap just resets itself. You're right back to payment number one, where 87% of your money goes straight to the bank. You can spend your entire life living in the first decade of a mortgage, paying almost pure interest over and over and over again. And this is how you can pay a mortgage your whole life and retire with very little home equity. So let's zoom out. If you did say stay for a full 30 years, you paid the total of $957,960 for that $400,000 loan. Twice as much. That's over $500,000. $557,960 to be exact, in pure interest. You didn't just buy a house for yourself, you bought one for the bank too. And what if the system could be made even worse for you? Because this is what Dylan was talking about earlier this year. There has been a proposal for a 50-year mortgage pitched as a way to make housing more affordable with lower monthly payments. Donald Trump had the discussion. They have not voted on it yet. It is in the processes, but there's a lot of checks and balances that has to occur. It is possible by the time Trump gets out of office that we will have the option for 50-year loans. But as it stands, the opportunity for having 50-year loan mortgage set up within the next 15 months is highly unlikely. So we will be living off of the standard 30-year mortgages, and then for the VA potential hardship mortgages of 40 years if you've missed a couple payments. So if you did manage to, in the generation of 50-year loans, have that same $400,000 house, get a loan for it at 7%, and utilize the 50-year payment option, your monthly payments will go down from $2,661 down to $2,351 a month. It's not a lot, but on the surface, it looks great that you're saving over $300 a month compared to the 30-year loan. That might be just inside of the cusp of what you're capable of affording on your monthly payments. But this is the deadliest trap of all, because if you pay that loan for the full 50 years, which, recognizing that the average life expectancy is closer to 84, you would have to get into that loan in your 30s and stay with that house for 50 years. But if you did, you would have paid over $1,012,000 in interest alone on top of the $400,000 house. That's nearly double the interest of the 30-year loan. You pay a staggering $455,000 extra just for a slightly lower monthly payment. It's not worth it if you're trying to turn a profit. It's worth it if you can't afford to pay the bill. But here's how you can flip that trap on its head. What if you took out the 50-year loan, but instead of paying that minimum $2,354 payment, you just round up and paid the original 30-year payment of $2,661. The extra $307 a month goes 100% to the principal. Yeah. And if you were to round it up to $2,700 a month, you would have $347 going straight to the principal. Doing this, you would no longer be on a 50-year timeline. You are now on track to paying off your loan, off the whole mortgage, within 30 years, just like the normal loan would have been. You've just used the bank's system against them, potentially qualifying for the loan with a lower payment, but then immediately erasing 20 years of debt and saving yourself over $455,000 in interest. Now, some people might say, well, why not just get the 30-year loan if that's what you're going to do? Reason being, two things. One, if you can afford the $2,300 loan, but you're capable of paying the $2,600 loan, the longer you're paying the $2,600 loan, the lower your total cost of the house is over time. In a moment when you might not be capable of paying that whole $2,600, but you're still able to cover the $2,300, you can pay the smaller amount and not default on your loan. That's the first benefit. The second benefit is individuals that refinance. The more equity that you're putting into the house in the earlier years of having the house, the more likely you can refinance for something. So say you manage to build up an extra $50,000 worth of equity towards the house. Well, I mean, think about this. If you're putting an extra $350 down a month on the house, you're putting an extra $3,500 to, let's say, $4,000 extra dollars a year down on the house. So if you held the house for 10 years and you were overpaying on it for 10 years, you'd likely have an additional $40,000 worth of equity on the house on top of the original amount that you would have gained, which might mean you might have about $50,000, $60,000 worth of equity in the house 10 years into ownership on a 50-year mortgage. If something happened and you needed to take out a second mortgage on a house, you'd have $50,000 worth of capital there to make that happen. Also, if you're overpaying on a house and you wanted to refinance the house and stretch out the loan for a longer period of time, which could potentially reduce your payments again while they're calculating larger quantities of interest on the house, there is a factor that you're overpaying on the mortgage, which gives you the capabilities of reducing the minimum amount that you're required to pay, which the lower that gets, the more you can overpay on it, which still allows you to cover the cost of the loan in lump sums, which is a benefit for you. Because while you have the capabilities of paying the house down sooner, you also have the capabilities of building a safety net around your monthly payments. And if you know that you're capable of overpaying it by $3,000 and you only put down $2,600, $2,700, and you take that extra $300 a month and put it aside in the bank to give yourself an extra couple of payments worth of security fund there, so that if you don't have any money to pay the bills, you can just take it straight out of your account and cover that cost. You're actually able to keep yourself from defaulting on the loan while you get yourself together for a few months. So if you were one of those feds that were dealing with the furlough from the shutdown, you would have still had 2 extra months worth of money to cover the mortgage while you're trying to figure out everything else in your life. At least the house would have been secured. But let's not forget that we had that terrifying innovations scenario from before the 2008 financial crisis, like negative amortization loans. On those, your payments were so low when they give you such low monthly payments, it didn't even cover the interest. So every month, your loan balance was actually going up. And thankfully, these specific products are rare in the United States today, but they are a chilling reminder of how the system is always looking for new ways to keep you in debt. So you don't want them to make your payments so low that you're not able to put a dent in the principal. And you also don't want the payments to be too high that you can't afford it. Which is one of the reasons why the next time you go to the dealership to finance a car, you should probably look at the total price of the car and the cost of the amenities. And then you want to discuss with them what can be taken off the price of the car versus what can't. And when you're going to buy a car, it's a situation that you're probably going to want to go there first thing in the morning. And you're probably not going to leave the dealership until the dealership closes. So you want to get you some exercise, prepare for this, get to the dealership and get comfortable. Okay. Because this is going to be like an 8-hour journey. This isn't a situation for you to get the lowest price that you could potentially get. It's going to be an 8-hour journey, or you're going to walk out of there not with the car that you want, or you're going to walk out of there with a payment option that you really didn't want to have. You'll get the car that you want at whatever they tell you that'll pay for it if you're not going to negotiate the deal with it. So the system isn't broken. It's built this way on purpose. Now, that was the bad news. And it is bad news. Seeing those numbers should make you angry. But before we're going to channel our anger into action and see the trap and get into how we're going to break this down where you can take back your control, I want to take a brief moment and touch base on Bro Logic's discussion the other day, because he came to us with some information and they jumped into our relationship topic, talking about finance, which was completely left field. And I gave him my word today that I was going to cover the information, and I'm going to cover the information today because he talked about gold going up soon. He talked about XRPs. He talked about tokenization. And he brought up a very large quantity of information that would make a lot of people ask questions. And it was clickbait information that clearly redirected our discussion because it was actually a privileged comment that derailed the whole show twice this week. So, my word, I'm going to derail the show real quick. And I just want you guys to stay tuned, because after I cover this short synopsis of Bro Logic's feedback on gold and everything to that effect, we're going to get back to how we can actually make money for ourselves and spend less money on this real estate. Okay. So, Bro Logic has been coming to the show often this last week, popping up on the show with the rumors from social media, in forums and in the anxious corners of the financial world, where this number of $25,000 is supposed to happen. And the claim is that perceivably by February, just a couple of months away, that the price of gold won't just creep up, it will be suddenly revalued to an incredible $25,000 an ounce from its current $4,000 an ounce level. And it's a story that taps into our deepest fears of currency collapse and our wildest dreams of finding a golden lottery ticket, the same way he was telling us about how cryptocurrency was going to explode. And we're going to be covering cryptocurrency specifically on Tuesday, so I'm not going to talk about that topic right now. But let's cut to the chase, because in this scenario, it is almost impossibly unlikely. So I wanted to go ahead while Bro Logic was here. I don't know if you're still listening, Bro Logic. I want to go ahead and discuss with you today, because we're going to break down exactly why the $25,000 figure is more of a fantasy than a forecast. He said, then what? Oh, after I finish talking about this, then I'm going to tell you how to get financially savvy with amortization with your real estate. So we're not here to dismiss the anxieties of those other individuals that makes the idea so popular. The worries about government debt, inflation, and stability of our financial systems are completely valid. But my job here is to separate those valid concerns from the viral hype. So we're going to look at what it would really take for gold to hit that price, and what history tells us, and what the world's biggest financial institutions are actually predicting. Now, the data points to a very different story, one that ends closer to a still impressive $5,000 target grounded in reality, where Michael actually had claimed this before, that it would be somewhere between 5 or 6,000, but not 25. But I couldn't really chime in on it because I had to do the research and find out what the case was. And while the $5,000 target is more reality, not wishful thinking, let's separate the hype from what's real. Now, before we debunk the number, we need to ask why a claim of $25,000 of gold by February is getting so much traction in the first place. This isn't just random noise. It's a narrative perfectly built for our anxious times. First, it plays on the fears and the desires for a simple fix. So we're living in an era of serious economic anxiety. People see massive government debt, inflation chipping away at their savings, and geopolitical chaos that seems to get worse by the day. These are a lot of the claims that Bra Logic came in here and illogically pronounced as excuses as to why gold was going to spike in a couple of months to $25,000, and sell all of your stocks and sell all your, and you're going to miss it if you don't. Don't listen to that. These are problems, and they create legitimate fears that the system is very fragile. The $25,000 gold rumor swoops in with a powerful promise. Just buy gold, and you're not only to be protected, you'll get rich when the system resets. It's a lifeboat in a stormy sea, and that promise is so tempting that people are willing to ignore the facts, which is why I come to this show to bring you the facts. The second rumor is, and it is not a fact. Before I keep going, the second rumor is very clever because it's wrapped around a tiny kernel of truth, which is then stretched into extreme levels of fiction. The whole idea of a revolution isn't completely made up. Some commentators point to theoretical exercises to make their case. For instance, analysis like Tavia Costa of Crescat Capital have noted that historically U.S. gold reserves were worth a much higher percentage of government debt, as much as 40% during World War II. And if you applied that same math today, you'd get an amplified gold price in the tens of thousands, with some calculations landing it near that $25,000 statement. But here's the part that gets lost in social media. These are thoughts, experiments, not forecasts. They're designed to show how far we've strayed from a gold-backed system because, as Donald Trump in his first term declared, the US dollar is no longer backed by gold. It is not to predict that we're going back to one of those backed by gold models tomorrow. And since the United States dollar is not backed by gold, the value of the dollar only is expressed in contrast to the increased cost of products, which means that how much you could get today versus how much you could have gotten years ago for the same quantity of money is the calculation of buying power. If the American dollar loses essentially 10% of its buying power, you're getting 10% less stuff today than what you would have gotten 25 years ago or 50 years ago for the same quantity of money. However, when the value of the dollar in today's market goes down in comparison to exchange rates with other countries, your dollar for dollar US purchase with US money on US soil is not impacted by that. But how much money you have to spend in another country is impacted by the devaluation of the US currency versus another currency. That's currency exchange. None of that has anything to do with the value of gold because gold is not tied to US debt. So even though the United States debt is in $37 trillion worth of debt, actually technically it's around $30,000 worth of debt right now. However, the debt has been earlier this year that if changes would be made, it would be made by them creating in the mint a different type of coin that could potentially be valued at over $1 trillion if they did something to that effect. And that particular type of coin would then be able to massively offset the value of the US dollar, where people would be buying shares of this $1 trillion coin, especially if he was to do 40 of them, and that would essentially erase the debt if done that way. And that hypothetical, though, not an actual action, which would then put a lot of people in a position to have the value of the US dollar, if the budget could be widely managed at that point, to then be more than what it is now. And then you would have more spending power in another country, right? So social media strips out all of that nuance, and a theoretical what if becomes a definite what's next, which throws everybody through a loop. Now, the third thing that you have to deal with is that social media is an echo chamber. Algorithms are built to push sensational headlines. Posts that are screaming $25,000 gold is coming will always travel faster than a measured analysis from JP Morgan predicting a move to 4,000 or 5,000 to get a share in groups that are already convinced the system is rigged, creating a feedback loop where everything like and share makes the idea seem more and more like a hidden truth in the mainstream, where the major media would likely be trying to suppress that truth. But that's not the case. So much fake news can be produced on social media that you can't tell right from left. But what you could tell is that the truth is not capable of being suppressed as readily because it's instantly thrown out onto the internet. Now, special shout out to Nemo. He asks, is he blind or is it just too sunny inside his home? I shine brighter than the sun, so it's too sunny in here. Likewise, though, Geordie LaForge, you remember him from Star Trek. He was the pilot of the ship. How can a blind man read your text? And how could Geordie LaForge's blind behind fly that ship? Make sure you like and subscribe. A lot of us never thought about that. We watched Star Trek for years. And then the day that he took off his Cyclops glasses, He had no eyes and the little dotty things on the side of his head and was like, oh shit, that man can't see. How the fuck does he fly the ship? Autopilot. We just put him in a chair because the ADA laws require us to give him a job. So we put him in the autopilot Tesla chair and let the car drive itself and make Jordy feel useful. Now, back to this so that I can get back to the real estate thing. The final rumor that we hear, which Bra Logic comes up and talks about, this one's going to rely on a distorted reading history. Proponents will point to President Franklin D. Roosevelt's 1934 Gold Reserve Act, which repriced gold from $20.65 to $35 an ounce overnight. And they present it as a proof of evidence that the government can simply decree a new high price for gold whenever they want to, but they're leaving out one massive detail. The United States was on the gold standard back then, back in the 30s, when gold was being priced by the United States government. Today, we are not on the gold standard. No major central bank has announced any plan to return to a gold standard. And I really actually have to do a show about this one day for us to really think about exactly what you would have to do to really be on a gold standard as a individual or as a business. But the context is completely different than the events that are being used to give the rumor a false sense of credibility. And when Bro Logic dives in and starts talking about this stuff, because we might have some knowledge about some things in some places, we don't know everything about everything. So if any one fact is mixed into a large number of what is called false truths or complete lies, you can't really refute it because you haven't done your research. You were bombarded with a large quantity of rumor, and it is what it is. It's a large quantity of rumor. But when rumors devalue the scenario and debunk your capability of being successful, that's when I have to take a stand and I have to start breaking through the noise and pulling back curtains so that you can see exactly what we're supposed to be trying to do here. Now, when you mix that economic fear with a twisted bit of truth, social media algorithms, and a warped view of history, you get the perfect storm for a financial myth. And this compelling and easy to understand system is, as we're about to see, completely falling apart when you look at the math. Now, let's talk about this real quick. And I'm going to crunch some numbers. But this is where the theory really breaks down. For gold to jump from its current price of a little over $4,200 an ounce right now in 2025, in November going into December of 2025, to a whopping $25,000 by February, it would need to increase by nearly 6 times or almost 500% in just a few months. A move that is huge. And that move isn't just unprecedented. It's nearly impossible in any world that isn't in a state of total collapse. Okay? So to get a sense of scale, let's look at gold's total market value. As of mid-2025, the entire above ground stock of gold is estimated to be around 218,000 metric tons at about $4,200 per ounce. That total value of all gold ever mined is roughly $29.4 trillion, which is about $1 trillion or $600 billion less than the total US debt. Now, let's pretend that the price hits $25,000 per ounce. That same amount of gold would suddenly be worth over $175 trillion. What would that mean? Well, it means gold would be worth more than every stock on every stock market on the planet combined. It would be worth more than the entire global bond market. It would have a value that would be nearly double the world's annual GDP. And for gold to become the single largest asset class on earth, dwarfing all of global industries and innovations, it wouldn't be a market shift. It would be a sign that everything else has failed. Special shout out to Max Opposer. I see you, guy. He said, have you seen the uprising crater known as? No, I haven't. And it is late. It is past your bedtime. Did you do your homework? Have you been studying? Well, you shouldn't be taking. Okay, so he asked me, do I agree with the black pill or the red pill? But you shouldn't be taking pills. You're too young for that. You should try more natural approaches. Um, Find a way to get you some exercise and go out into the street and do some jumping jacks, not while moving traffic is headed towards you. Uh, Run uphill with your skateboard and then ride down the hill with your skateboard. That's not how you spell that word. There it is. The psychological. You're talking about the psychological aspects. Well, the psychological aspect, the psychological aspects related to blue pill and red pill, or black pill, because you said black pill, um, are social constructs based on social and geographical debates, which are typically one-sided debates from individuals that are extremely close-minded to broad spectrum scale knowledge and sources, which typically compromises any logical and rational discussion, because logical and rational discussion doesn't just analyze the problems and the facts. It more to the magnitude addresses what is the issue and then how do we solve it, which is what I do on this show. I actually bring up what the problem is and then I tell you guys what to do to solve it. Now, for price jumps like the $25,000 gold thing to happen naturally, you would need a wave of buying so huge that there's no historical comparison for it. And we aren't talking about a few $1 billion moving into gold ETFs. We're talking about trillions and trillions of dollars flooding into a relatively small market all at once. And where would that money even come from? Because it would mean a complete and total abandonment of every other asset. People would have to sell their stocks, bonds, and real estate. Everything would have to go and pour all of it into gold, only gold, nothing else. And this isn't a flight to safety, it is a stampede into one asset that signals the end of the financial system as we know it. This is why the proponents used the word revolutionary, suggesting a government will just announce a new price. But think about the consequences. Anyone holding gold would see their wealth multiplied by nearly 6 times overnight. Meanwhile, the mass majority of individuals without gold would have their savings and currencies catastrophically devalued. It would be the biggest wealth transfer in human history, wiping out the middle class and creating a new global aristocratic era of gold holders. The social and political chaos that would follow is unimaginable, and it would also bankrupt nations and financial institutions with short positions or derivative contracts that are tied to gold. Now, the derivatives market, which is vastly larger than the physical market, would implode. Every central bank would be in disarray. While the US has the world's largest official reserves, countries like China and India would see the value of their holdings explode, instantly redrawing the map of global economic powers. So a $25,000 price isn't a feature of a functioning system, it is a symptom of a completely broken one. And it implies rampant hyperinflation, a collapse of all other assets, and the breakdown of social order. And that isn't a scenario that just around the corner for us. It is a doomsday scenario that has no basis in our current reality. So it is completely false. Now, history is usually our best guide for the market, and it tells a very different story about gold. Gold has had some wild rides, but nothing, and I mean nothing, comes close to the claims of a six-time price jump in a few months. So let's look at two of the biggest gold bull markets in modern era. The first one was a famous spike in 1979 to 1980, which he didn't talk about. Logic didn't talk about. That era was defined by a perfect storm of stagflation in the United States, high inflation, high unemployment, and a stagnant economy. The Iranian Revolution and the Soviet invasion of Afghanistan added a layer of geopolitical panic as confidence in the dollar collapsed. And the same time, gold went on a legendary run, soaring from about $200 an ounce to a peak of over $850 in January of 1980. And that was a stunning four-time increase. But here are two key facts. First, that really took place over years, not months. Second, the economic conditions were extreme, with double-digit inflation and a real fear that the government had lost control. The government hasn't lost control in 2025. He has complete and total control over what he's doing. While we don't necessarily know what the plan is, and not all of us agree with what he does, it doesn't change the fact that he knows exactly what he's doing. The second major bull run followed in 2008, which is what we were talking about with real estate, and you had the global financial crisis as central banks fired up the money and all of the printers started working in overtime with quantitative uh, easing and cut interest rates into zero factors. We developed levels of fear currency, data basement spreads from its low in late 2008 to its peak in 2011, which is 3 years. Gold rallied from under $700 to over $1,900 an ounce, and that is a nearly three-time increase. Once again, this was a multiply of over the years climb driven by a crisis that shook the entire globe banking system consistently for years. That really has been fueled in today's market by its own powerful forces. So sticky inflation, geopolitical risks, and most importantly, massive and stunned uh, buying power from the world's central banks are not all that it's going to take to make things jump up to 25 grand. After sanctions froze Russia's currency reserves in 2022, and we just sanctioned them in 2025 with the attacks on Ukraine. In emerging markets, we have buying gold at a historic price with a net purchase exceeding 1,000 tons annually in recent years. They see it as the ultimate neutral asset, one that can't be frozen by a foreign power. This institutional buy is a structural shift, and it's a key reason gold is trading over $4,200. But this rally has followed a historical pattern, a steady multi-year climb, not a single quarter jump. Even the most bullish analysts see this trend continuing, not going uh, parabolic. So they know that a move to 25,000 would require a crisis bigger than that occurred in 1970 in stagflation, that also led into the 2008 meltdown climbs. And history shows us that the gold runs are marathons, not 100-yard dashes. So if the $25,000 is a fantasy, what's the reality? Real story is that a continued steady climb towards $5,000 mark. It is not a sensational headline, but it is a forecast backed by large banks that publish commodity and macro outlooks with explicit gold price targets. Now, these reports give back uh, case by case and bull case ranges that are also backed by sophisticated models. Now, the world's major banks are overwhelmingly bullish on gold, but their targets are set by data, not doomsday theories. So, for instance, Bank of America projects that gold could reach $5,000 per ounce by 2026. JP Morgan, which has also become more bullish, sees a path for gold to rise past $5,000 by late 2026. Goldman Sachs and UBS have also raised their 2026 forecast with some bull case scenarios approaching 4,900 to $5,000 levels. So between now and December of 2026, not too many people are really saying that it's going to hit $6,000, much less $25,000. But note the pattern. The sharpest minds in finance are all pointing to a small range, that high 4,000s to low 5,000s, nowhere near 20 to 25,000. And they're all doing it for the same clear reason, using models based on interest rates, inflation, the dollar, and central bank demand. Now, the most powerful driver is the relentless demand for central banks. And this isn't just a trend, it's a structural shift. So the World Gold Council reports that a vast majority of central banks, which is about 95% of those surveyed, plan to keep buying gold. And countries are steadily increasing their gold reserves to hedge against the US dollar and hold a sanction proof asset outside of Western control. And this creates a strong flood under the gold price and fuels further gains. The second, what? The second driver is the expected policy pivot from the US Federal Reserves. After a cycle of aggressive rate hikes, the consensus is that the Fed will begin cutting interest rates. Lower interest rates decreases the opportunity cost of holding gold, which pays no yield, making it far more attractive than bonds or savings accounts. Third is the long-term problem of government debt and currency uh, debasement. The US and other nations are running massive deficits and piling up debt. Historically, the most common way to manage unsustainable debt is to devalue the currency through inflation. Investors know this, and they are using gold to protect their wealth from this slow erosion of purchasing power. Finally, geopolitical uncertainty isn't going away. From trade wars to regional conflicts, the world is a messy place. So, for thousands of years, gold has been the ultimate safe haven asset, financial insurance against the chaos. As long as these tensions continue, investors will seek it out. So, when you comb these four forces, structural central banking buying, independent rate cuts, currency debasements, and geopolitical risks, the case for a continued bull market is incredibly strong. It's not the overnight explosion promised by the $25,000 crowd or by Bro Logic. It's a logical data-based path towards a $5,000 level, which is about $800 spike from where it is right now over the course of the next 13 months. Look at the idea of $25,000 uh, worth of gold is expecting to be really excited for those people who already have gold. And I get it. It's a narrative built on a real anxiety, but isn't uh, propped up by, it's only going to be propped up by the bad math and a distorted history. It's a product of social media hype, not sound analysis. A 6-time price jump in a few months wouldn't be a bull market. It would be the signal of a global economic meltdown that is simply not supported by the evidence, which is one of the reasons why Bro Logic could not bring us any evidence that would indicate his claims. Now, the real story, the one told by the data, is less dramatic, but far more credible, where in a powerful bull market for gold, driven by unprecedented buying from central banks, the prospect of lower interest rates and the slows of reality for currency debasement, these are the forces that have led institutions like Bank of America, Goldman Sachs, and JP Morgan to all forecast a continued rise with price targets clustering around 5,000 over the next 2 years. One of the things that I want to tell you is that for the average individual, if we're going to invest in gold, um, since the cost of storing it and the cost of insuring it is going to exceed the price increase year over year, in order for the individual investor to turn over a larger profit on gold, we would probably do better putting our money towards investing in ETFs that are backing gold value. So if you find on some of the shows that I've done, when I talk to you guys about investing in precious minerals and precious metals, gold, silver, platinum, and all that other stuff, that if you go and look for ETFs that fund gold mining or gold companies, then you would be able to have the value of gold stock, again, stock, not the physical gold, on the market, where at any point in time you would have an easier accessibility to acquiring your money back from the stock, as long as the stock doesn't crash, faster than trying to find a place that will take your gold. Like we had somebody come onto the show and talk about how they sold an ounce of gold for $2,500 at a pawn shop, recognizing that right now when they sold it, the gold was valued at $4,200. So that guy lost a ton of money selling his gold bar at the nearby pawn shop to get quick cash. Now, it's still a powerful move that offers real potential for wealth protection and growth to go and buy gold, but it's one based on rational market forces, not on a fast fantasy of a reset of the world's order. So understanding the difference between hype and reality is the most important step that you can take there. So don't get caught up in chasing any impossible lottery ticket. You want to focus on the real drivers that are steadily pushing the gold higher. Now, another thing I want to talk about before we get back to giving you guys all the information that you need to knock back the cost of buying a house, I want to get into this XRP thing that Bro Logic came into the show with. The claim had suggested, the claim that came from Bro Logic was that a global financial reset where XRP becomes a core settlement asset, its price is supposed to be exploding to levels that are hard to even imagine. And we're seeing posts talking about XRP hitting thousands of dollars, all tied to this supposed gold backing story. Remember, he said something about Dubai was supposed to be taking it over, and then they were supposed to be backing by XRP and all this other stuff. It's a powerful narrative, especially for those who've held on through the years of market validity. The idea creates a potent mix of hope and explosion or exclusivity in the explosion. Um, but this suggests that those in the know are the ones on the verge of an unprecedented windfall yet again. But where does this story actually come from? And more importantly, is there a single shred of evidence that supports it's either? He said, Felix, some say that I kind of look like Papa Doc from 8 Mile. I got a very familiar face. Depending on whether or not my hair is braided or not, I could potentially pass off as Andre 3000. You know. Now, the XRP gold myth is a masterclass in modern misinformation. So I want to get down to the bottom of that. It thrives in social media echo chambers as well, amplified by influencers and anonymous accounts like Bralogic, who present speculation as fact. They weave together unrelated threads of truth to create a convincing yet entirely false tapestry. They'll point to the US government holding vast gold reserves, because that is true. And they'll point to the government's growing involvement in digital asset, because that's also true. And they'll utilize that to say that cryptocurrency is going to blow up again because of it, even though it kind of settled down after Elon Musk gave Donald Trump the middle finger. And then they'll highlight the XRP potential as a fast, efficient payment tool, which XRP is, again, true, a very good payment tool. But then they'll mix these three separate facts, and then they'll create the illusion of a connection. It's a classic sleight of hand. The narrative blurs, and the lines between government policies and private sector technology, leading hopeful investors to believe a government sanctioned moonshot is imminent. These stories create a FOMO effect, the fear of missing out, which can manipulate the market before an inevitable crash. But when you pull on the threads, the entire story starts to unravel. So we're going to be clear again. There are no credible evidence, no official documents, and no statements from Ripple or the United States government that suggest that XRP is or will be ever backed by US gold. Where industry experts have repeatedly debunked this, and I'm going to be, again, one of those experts that's going to debunk the myth. Former Ripple director of developer relations, Matt Hamilton, has stated for years that XRP's decentralization design is fundamentally incompatible with being backed by a centralized asset like gold. So to back XRP with gold, a central entity would need to hold the gold and guarantee convertibility, with defeats which would defeat the purpose of the XRP ledger's structure. So that's an issue in and of itself. Holding the gold as a guarantee for convertibility is going to defeat the XRP ledger structure. XRP's value is driven by market supply and demand and its utility, not by a hidden pile of gold bars in Fort Knox, which a lot of people say doesn't even exist. So if the government isn't backed by XRP with gold, what is it doing? This is where the kernel of truth gets twisted, because on March of 2026, an executive order was signed to establish a stringent Bitcoin reserve and the United States digital asset stockpile. And this policy we covered on the show is about the United States government managing the cryptocurrency it has already seized from criminal cases, like the takedowns of the Silk Road Marketplace and the Bitfinex hack. From these seizures, the United States now holds an estimated 200,000 Bitcoin through a full audit is still pending. So the Doge audit that I do believe Doge just wrapped up its audit, it is still pending as to how much of the Bitcoin that they have, but 200,000 Bitcoins is what they have right now. And at 100,000 coins per coin, that's what, 2 million? Or I could be mistaken the zeros, $2 trillion worth of Bitcoin. But the creation of the strategic Bitcoin reserve is a move to treat these seized assets, primarily Bitcoin, as a national reserve, similar to gold or oil. So instead of immediately auctioning it off as it did in the past, the new policy is to hold it strategically. But here is the crucial distinction that the rumor mongers over conveniently and ignores. This reserve strategy is overwhelmingly focused on Bitcoin, while others have seized digital assets like Ethereum, Selenia, and XRP. It will be held in the separate digital asset stockpile. The core reserve strategy is explicitly named the Strategic Bitcoin Reserve. So when you hear whispers of the United States government and a crypto reserve, understand that they are talking about managing seized assets with a clear strategy focused on just the Bitcoin, not about underwriting a private company's token with the nation's gold. Now we're about to get into the real story with the drivings of XRP values and who actually benefits from the gold backed fantasies. So if you're tired of the hype and you want more deep dives that separate fact from fiction in crypto, make sure that you hit that like button and subscribe to the channel, and make sure that you come back on Tuesday, because we're also going to be talking about the flop in cryptocurrencies over the past few months. And this is the best way for you guys to stay informed and protect yourselves from that next big lie. Now, if the gold backed rumor is a fabrication, does that mean that XRP has no future? Not at all. The real story isn't about XRP being backed by gold. It's about the XRP ledger being a platform for tokenized gold and countless other real world assets. So the key is the XRP ledger is built to support the creation of digital tokens that represent real assets, a process called tokenization. So imagine a world where a bar of gold in a vault is represented by a digital token on the XRP ledger. That token is backed by gold because an insurer holds the physical gold in a reserve, and its ownership can be transferred instantly and cheaply across the globe. In this scenario, XRP itself isn't gold. Instead, it acts as the bridge currency, the natural high-speed rail that allows for the exchange of these tokenized assets. If you want to trade a token representing US dollars for a token representing gold, XRP can facilitate that transaction in seconds for a fraction of a cent. Its role is to provide liquidity and serve as the plumbing for new tokenized economies. Now, this isn't a theory, it's already happening. Ripple and the XRP ledger are actively positioning themselves for the massive market of real world assets, tokenizations. A widely cited 2002 report from Boston Consulting Group projected this market could reach over 16 trillion by 2030. We're in 2025. That means 5 more years. So we're already seeing projects launching things like tokenized US Treasury bills and digital commercial paper on the XRP ledger. And this is where the real institutional interest lies. So who is promoting the gold lies Besides Bra Logic, well, it's a mix of players. Grifters who create hype to pump and dump their holdings, overzealous supporters who get caught up in the excitement and share misinformation unintentionally, and influencers who know that sensational claims generate more clicks than sober technical analysis. The lie benefits those who prey on financial desperation, selling a get rich quick fantasy instead of a complex long term technological shift, which I keep telling you, it is a 20-year or longer plan to get rich. It is not an overnight sensation, and anything that happens overnight is not stability. So the great XRP gold lies is just that, a lie. So there is no plan to back XRP with US gold. The government crypto strategy formalized in March of 2025 is centered on managing its seized assets, primarily Bitcoin, through a strategic reserve. And the rumor is a dangerous distortion built to manipulate investors and potentially troll podcasts to take away from the attention of the main topic. However, the truth behind the lie is compelling. XRP's future value isn't tied to a century old monetary standard, but to its potential role as a fundamental layer for a new tokenized economy. Its success will depend on real world adaptations, regulatory clarity, and its ability to help move trillions of dollars in tokenized assets. And this is a story about technological utility, not a secret government plot. So, as an investor, your decisions should be based on fundamentals, not fantasy. You want to understand the technology, the use case, and the risks. The crypto space is full of narratives designed to separate you from your money, and your greatest tool is skepticism. Question everything, demand evidence, and never invest more than you can afford to lose. So I'm going to say that again. Never invest more than you can afford to lose based on an anonymous tip from the internet, especially somebody who jumps up onto the podcast, can't even show their face, and make a claim that is too good to be true. Any promise of easy riches is almost always an illusion. The promise of revolutionary technology, however, is worth paying attention to. Just make sure that you know the difference between the two. So I bring you guys long-term game plans, long-term strategies. It's not something overnight. You're going to have to make payments on it. You're going to have to save towards it. You're going to have to put something up towards it. You're going to have to build it to get it to where you want it to be. It is not an overnight sensation, and it's going to take you 10 to 20 years to see the positive results of it, but you can start seeing small increments of results in a month-to-month basis. So if it takes you 30 days to see a benefit, if it takes you 90 days to see a benefit, and then you have to scale up that benefit by continuously investing in it, it is not an overnight sensation. You can't just put your money up for 3 days and come out of it with a millionaire. Because even if you were doing a dividend rotation strategy that we talk about, and you put up 100 grand on a stock, and that stock loses $2 a share, and you have 10,000 stocks, you're losing a lot more money than what you think when you start doing it on a grander scale. Yeah, the money that you get back is the money that you get back. But if you're getting back $1.75 a share and you're losing $2 a share, you lost 75 cents a share. And if you have 100,000 shares, you just lost $750,000. So you got to think about what you're trying to accomplish and where you're trying to accomplish it. Small scale investing, you can utilize dividend rotation strategy, because if you put up $10,000 and move it around, you can turn that $10,000 into $22,000. Yeah. And then give the government $4,000 worth of taxation. Of course. But would I recommend you doing that with 100 grand? Not unless you're willing to lose 20 grand of it in the process of gaining 15 grand. You might be able to turn 100 grand into 250 grand. You might be able to, including wins and losses, turn 100 grand into 175 grand. But realistically speaking, with the taxation involved with 100 grand transactions, you're more likely to be able to buy and hold using a core satellite portfolio and adding to the principal, and then shaving off the difference when you start experiencing mild spikes in your portfolio where you're only shaving off a few thousand here and there and adding on a few thousand here and there, and only dealing with the difference between the two is taxation, if any taxation at all, if you're doing buy and holds. When we provide you guys with the information to be successful, we're providing you guys with the information to be successful. We're not providing you guys with information to sit here and what if and hypothesize. So when we get back to our real estate dynamic, we think about the system's biggest weakness in amortization is that it assumes that you will only pay the minimum amount of money. And that is where the hypothesis that you're overpaying on your house in order to get a mortgage actually comes from. The moment that you pay $1 more than the bank's profit machine starts to sputter, and the reason being is, but you're going to ask yourself why, because any extra payment that you make by law has to go 100% directly to your principal. This is the key that nobody knows anything about. Every extra dollar you send cuts away at the loan's foundation, reducing the balance that future interest gets calculated on. It's like skipping ahead in the marathon without the 50-pound vest on anymore. So let's start with a simple hack that you can use today. This one is incredibly simple. Look at your monthly payment. If it's $2,661, just round up to pay that $2,700. An extra $39 might seem like nothing to you, but it's the most powerful money that you'll spend all month because it goes straight to the principal. That $39 isn't just $39. It is money that won't be charged interest for the next 20 to 30 years. By paying just that tiny bit extra on your example loan, you'd pay off your mortgage 1 year and 7 months earlier and save over $27,000 in interest. Now, this is the next level up because the goal is to make one extra mortgage payment per year. But instead of a lump sum, you break it down. So take your monthly payment of $2,661 into our example and then divide it by 12 months. And that's about $222. Now, just add that to your mortgage payment every single month. So you'd be paying $2,883 instead of $2,661. Or if you wanted to round it up to an even number so that it makes more sense to you, you would start paying $2,900 a month instead of $2,661. The results is that you'd be paying off the loan 6 years earlier and saving over $120,000 in interest. Now, you've probably heard of this before somewhere over the past 20 years. Banks sometimes offer it for a fee, but you should never, ever pay for it. It's just a clever packaging of strategy 2. You pay half your mortgage payments every 2 weeks. Since there are 26 2-week periods in a year, you end up making 13 full payments instead of 12. You can set this up yourself for free through your bank's bill pay. Just stick with strategy number 2. If you're deciding that you're going to pay, if you're supposed to be paying $26.61 and you decide to make 2 monthly payments of like $1,500 biweekly payments, instead of agreeing to it with the lender, you just set it up with your bank where you're sending the lender 2 payments. And as long as both payments go in before the due date, where you're not late, you're good. So if your payment is due on the 15th of the month, last month you would have sent $1,500 towards your $2,600 on like maybe the 25th. This month on the 10th, you'd be sending them another $1,500 before the $2,600 is due on the 15th, where they would have gotten $3,000 from you instead of $2,600. That would be how you would work that out, setting up those advance payments. Now, one crucial point before you send any extra money. You want to make sure that you check the contracts, call your lenders, make sure that your loan documents for something like this uh, called prepayment penalties. You want to look for something like this on your loan contract. These are much rarer nowadays, but you need to be sure that that doesn't exist. And also, when you do send extra cash, clearly label it as for principal deduction only to make sure it's applied correctly. Um, this can work where if you're doing auto pay from your bank account and then you send a cashier's check or money order from your bank and then label it specifically for principal reduction only. This will limit what they do with the money when they get it. Now, we're about to get into the more advanced strategies, but knowledge is only powerful when you use it. So make sure that you guys take the opportunity when you have time to take a look at our membership, because we will be giving you guys amortization buster information spreadsheets that you can gain access to see how this works with your loan, specifically for members. So you'll be able to plug in some numbers and see it for yourself and be able to crunch some numbers from time to time and see how much money that you can save. Seeing that you can save $50,000 or $100,000 is incredibly motivating. So you want to make sure that you go to the membership in the description, and you want to be able to take a look at um, your decision to get in on all of the extra information that I got provided for you guys to make you guys more successful. Now, if the first two strategies were about chipping away at the chain, uh, these next ones are about taking a sledgehammer to those same chains. Most people think refinancing is just about getting lower interest rates, but the most powerful way to refinance is also to change your loan's terms. So I'm talking about refinancing from a 13-year mortgage into a 15-year mortgage. Let's go back to our loan. Say you're 5 years in, your balance is down to about $378,000 from that $400,000. You've paid the bank over $160,000 just to knock off $22,000 in debt. You're disgusted. You see that as of late 2025, a 15-year mortgage rate is around 5.51%, while the 30-year rates are about 6.23%. You decide that you want to refinance the remaining $378,000 into a 15-year loan. Yes, your monthly payments will go up, but you are forcing yourself onto an accelerated path. On a 15-year loan, a huge chunk of your very first payment goes directly to the principal. You build equity and a staggering rate. By switching, you could save over $200,000 in future interest and be completely debt-free a decade sooner. Now, this is for people with stable incomes, but it's one of the best ways that you can break the cycle. Now, the final strategy is the most aggressive, and it is not for everyone. But this one is the one that you hear about in Pay Off Your Mortgage in 5 to 7 Years video. It can work, but it requires serious financial discipline. If you aren't great with budgets, don't attempt this. Matter of fact, if you suck at maintaining a stable income, it is in your best interest to get the longest loan possible with the lowest monthly principal or the lowest monthly payment required, so that you can take more of your available funds to put on the loan every month that you can afford it. Potentially putting a percentage of your loan amount off to the side as an emergency fund in case you have months where you don't have money, so that you can offset the cost of when you don't have money to pay. You need to be able to budget the times when you can't afford to pay your mortgage so that you're not missing payments on your mortgage. Yeah, if something happens where the whole government goes to shit and then they offer payment options where they can help you pay your mortgage, you take advantage of that as well. But if you have a $2,600 a month mortgage, and you got $15,000 or $20,000 set aside just in case you can't afford to pay for the mortgage. If a company like Navy Federal is going to help you pay your mortgage, you can take the money that you're getting from Navy Federal to pay your mortgage and take the emergency fund and pay Navy Federal, or take the emergency fund and pay the mortgage and Navy Federal, so that by the time that catastrophic failure subsides itself, not only you can build up that emergency fund to cover the mortgage, but you can also expedite the enhanced payments during catastrophic failure, where everybody else is not making payments and getting exemptions, and you're continuously making payments and not having negative hits on your credit score. Now, this is going to involve using this fifth method is going to be involved using home equity lines of credit, or they're called HELOCs, as a weapon against your mortgage. The theory is to use a simple interest HELOC to attack your front-loaded mortgage. Now, here's the process. You get a HELOC, which is a revolving line of credit. You take a large chunk from the HELOC, say like $30,000, and you make a massive principal payment on your main mortgage. This instantly shaves years off your loan. This is the critical part. You got to pay attention to this. You direct your entire paycheck to be deposited straight into the HELOC. Every dollar that you deposit immediately pays down the HELOC balance, reducing the amount of interest that is charged. You pay all your monthly bills, groceries, utilities, even the mortgage payment itself out of the HELOC. At the end of the month, any leftover income stays in the HELOC, aggressively paying it down. Once it's paid off, you repeat the process again. The warning here, huge warning, this is a high wire act with no safety net. HELOCs often have variable rates. If you're not disciplined, you could end up with a big mortgage and a maxed out HELOC at the same time, putting you at risk for foreclosures. This strategy is a powerful tool, and it can build something amazing if you're capable of handling it. But if you're not careful, this could cause serious injury towards your financial stability. And it's one of the reasons why I tell you guys to play it safe. Get the stretched out loan, the 30-year, the 50-year, with the low payment. Then overpay it. Let's say the average individual that's making over $4,000 a month is supposed to be paying less than 25% or less than 30% of their standard of living in order to pay the house. You're making about $4,000 a month. You should be paying for a house that costs you less than $1,000 a month. If you're paying for a house that costs less than $1,000 a month, then you should be capable of getting a stretched out loan that puts your house at close to $700 or $800 a month. If your house is valued at about $700 or $800, or not valued, but costing you about $700 or $800 a month on the mortgage, for those very same people that are willing to pay $3,000 a month for rent, you could have that $900 a month payment requirement on your 30 or 50-year loan, and be paying $3,000 a month towards it, which is 3 times the amount of money that is required to cover the loan. Where $2,000 out of your $3,000 a month would be going directly on the house. You would be paying the house off 3 times faster. So if you had a 30-year loan and you're only supposed to be paying around $900 a month, you're paying $3,000 a month, you would likely pay your house off in 10 years. Now, the plus side of this particular method is if you are overpaying on your house, and 5 years in, you need to take out a HELOC, you've got more equity towards your house because you've overpaid on your house. So if, let's say your house was $150,000, $200,000, let's say it was $200,000 house. And out of that $200,000 house, you're probably going to be paying $350,000, which means that roughly over 30 years, you would be paying like $10,000 or maybe $15,000 a year, right, on the house. But if you're paying 3 times as much, where you're throwing down almost 30,000 a year on a house, you are likely to chip away at that $350,000 inside of 10 years, which also means that you are likely to cover the spread and inside of 5 years accumulate $50 to $75,000 worth of money towards the liquidity of the house, which means that you could take out a $50 or $75,000 HELOC line of credit on a house and use that to offset whatever it is that you're trying to do. Some people take these HELOCs out to get solar panels on their house, to buy cars so that they don't have to pay finance charges on the cars, or student loans, bail somebody out of jail or something to that effect. But if you use that HELOC to do things like your revolving bills, phone bill, light bill, water bill, you could pay that for the next 12 to 15 months. Just pay that out in advance. They owe you service now because their service comes at a fixed rate. Then you can take the remaining money and throw it on a house. Then you can take your whole paycheck and put it on the the HELOC and pay down the HELOC because all the bills are paid, including the house. If you knock something like that off, where your rent, light, gas, water, and car insurance are covered for the next 6 months, well, your car insurance covered for the next 6 months, but the rent, light, gas, and water is covered for the next 12 months, and the HELOC is covering the mortgage for the next 12 months, you're good to go. Then you could take your money and put it down on covering that HELOC and paying the HELOC down. Then you can utilize the HELOC again to cover the spread again. You could do this every 12 months and likely pay the house off within 2 to 5 years of starting to utilize the HELOC method, because you have lowered your monthly payments down dramatically. Likewise, if you were the kind of individual that decided to refinance the house, there's another option there. If you refinance the house and you got you a longer mortgage on refinancing the house because of all of the extra equity involved in the house, as long as the house is over $50,000 and you're refinancing the house, you're likely to find yourself in situations where you might have a $250 a month payment after refinancing. In that particular situation, if you're still putting down $3,000 a month, you are still knocking that down, but you now have, when all shit hits the fan, the minimum requirement of throwing down $250 to cover the rent, or $750 to cover the rent for the next 3 months. So again, in that government shutdown experience, all of your stuff would have been covered, and you would not have to worry about where you're going to get money from. Now, this gentleman came back and he jumped up and said, I'd rather buy gold with it. Well, that's not a smart move. If you were to mortgage your house or take out a HELOC against your house, now you basically have two debts against the house, and you take that money and you go and put it up towards the value of gold. Stupid move. Reason why it's a stupid move: gold is not appreciating that much where you would be able to sell the gold that the $30,000 or $50,000 worth of gold that you have to help you pay off your house. Second, you still have to sell the gold in order to get the capital back in order to pay towards your house. So if you were to take out a massive loan against your house to go and buy gold, that would be a dumb decision, because you would now owe all of the money for the house, all of the interest for the loan, and those two types of loans is going to be more than the profits that you would get off of gold. These particular strategies are designed to reduce the quantity of payments that you have to have, which reduces the quantity of interest that you have to pay, which ultimately saves you money on buying your house, since you couldn't buy your house cash up front. Now, after you own your house, if you decided that you wanted to mortgage your house and invest in something, you would want to invest in, whether it's gold, silver, platinum, Bitcoin, whatever it is, you would want to invest in something that is going to give you back a larger guaranteed return than the interest rates on your mortgage. So, looking at 7%, let's start with Bitcoin. Bitcoin, if you buy and hold Bitcoin, not massive trading, Bitcoin is going to give you a guaranteed 4% return, a little bit more than the bank. Bonds, a little bit more than Bitcoin, because bonds are like 4.1, 4.2%. Gold and silver is not giving you a massive return month over month, year over year, but it is increasing ever so slightly. But again, to Over the course of 3 years, you might see a 50 to 75% increase over 3 to 5 years in volatile markets, but it's not always a guarantee. All year, all of 2025, it has juggled between 3.7 and 4.2, which is about a $500 difference, which is about a 10% increase. When you consider the fact that you will get taxed on the increase on your investment, if you made a 10% increase on your initial investment on gold, after they take out the 10%, the 3% of taxation, ignoring inflation, you would have just enough money to break even on your mortgage before you consider any fees that are involved with the transaction of buying and selling the gold. Now, stocks is the only location besides real estate where you can turn about more money than the loan. If you took out an equity loan on the house, and that equity loan, or not an equity loan, but a HELOC, you take, yeah, it's equity loan. You take a HELOC out and you put that 50 grand into a buy and hold stock option that would hold and produce 20% monthly. Well, 20% annually, but revolving door if you did a 20% annual return. You owe the bank or the HELOC, well, not necessarily HELOC, because if you did a mortgage, the mortgage will be about 7%. The HELOC will probably be more than that. But if you did the mortgage for 7% or even 8%, and you take that money, you put it into a stock option that's paying you 20%, that difference is that you would profit before taxes 13% return. Now, the smarter move is not to mortgage your house and go buy gold. The smarter move is to, if you're going to do this, mortgage your house and go buy a 20% stock option from a blue chip company that's paying you cash dividends every month, because that company will give you more money back every month than what it costs to pay back the loan. One of the benefits of that is, though, in addition to this, is that after you've paid back the loan, you can take out another one, put a larger quantity of capital up there than what your original principal is, because the interest from your loan paid off your loan. The interest from your stock investment paid off the loan that you got, the mortgage that you got. So you keep the principal and pay off the mortgage. Then you do it again, and now you're going to be having a larger quantity of money there for your stock option, and you can still use that 20% return to pay off a smaller portion. So if you took out 50 grand the first time, you paid it off, you took out another 50 grand, now you got 100 grand there. Now you're getting 20 grand instead of 10 grand. And and that 20 grand that you're getting back off the 100 grand off the house, plus whatever you put on the stock option, the house is being paid for by the stock option. You can't pay for your house with the gold that you're holding because you got to sell the gold. You keep the stock option, and you use the cash from the stock option to pay off the loan. And the best part about that type of strategy is that the profits from the stock option are paying off a debt, which makes that a tax exemption. You borrowed money and then you paid it back. That's it on paper. So you've increased your assets by 100 grand over 2 different mortgages, and zero profit came about because you took all the money that came out and put it on the loan. Now, that's got nothing to do with your day-to-day paycheck, because your day-to-day paycheck stays in your pocket, because anything you do towards that type of transaction pays for itself. And since the money comes in on a regular basis at the same time, even if you decided, let's say that the payment happens at the end of the month, the loan is due at the beginning of the month, you pay for it with last month's payment off of the stock option, or you could pay for it with this month's payment out of the paycheck, and then reimburse yourself off of this month's stock option. Or you could start off by paying it off of your first check and then take the stock option and pay for next month, so that you're always a month ahead of the payback. However you do it, when you borrow against the asset, that's when the house becomes an asset. When you borrow against the asset and you turn profit off of that particular action, you start making far more money off of keeping the principal that you borrowed and paying off the loan. Now, utilizing these types of strategies allows you to leverage your house no longer as a liability, but leveraging it as a sustainable way to build wealth. Because if you went from just having a $200,000 house to having a $200,000 house and a $50,000 stock option, then you go to having a $200,000 house and a $100,000 stock option. Now you got $300,000. When you start leveraging all of your assets to get you a $150,000 quantity of capital, you can put that towards your $100,000 worth of assets and now have $350,000 worth of capital towards your $200,000 house, where you can then take that 20% return back and pay towards all of the stuff on the loan and not have to worry about where your money's coming from to pay the loan. How you doing, Hockey? Greatly appreciate that. Thank you so much. So just taking all of your money and throwing it on gold is not a logical or rational thing to do. Taking a percentage of your portfolio and buying gold, buying silver, buying precious metals, buying Bitcoin, buying real estate, and buying stock options are all, they will need to connect their mic before they can add themselves to the stream. So Mr. Satellite, you got to you got to add the mic in there. I see you, buddy. Good to see you. Good to see you diving in. I seen it gave a pop-up that Mr. Satellite is on the show. I see you, Mr. Satellite. The mic and the camera is gonna have to be connected before you can end up onto the stream. But I appreciate you diving into the background there. He said, I have no access to it. Oh, well, that's about as close as you can get onto the show, but I really appreciate you jumping into the back screen. He said, I don't know how to get it back. You have to, I guess, because you've identified, it says Turkey Burden is your YouTube account, and you would have to go back to your settings in the registration of your account and then approve the mic and the camera. That way you'll be in there, because I can't put you on because it won't let me, because you don't have access to a mic and you don't have access to a camera. But I do see you in the background, and I can see you in private chat instead of me seeing you in the comment section. But good to see that you dove in. Now, where were we? These strategies are very powerful tools, and it can build something amazing, or it can cause you some serious injury if you're not careful. So it is only for financially savvy and organized people who are structuralized about their finances, which also means that if you're in a relationship with a partner that is financially savvy as well, you guys can plan to take this type of strategy into action together, and you guys can alternate who's going to put up the money to cover these types of activities, which allows for you guys to take drastic improvements towards your wealth and growth, which would lead you guys inside of the first 2 years of your relationship to be financially wealthy. Whether your $500,000 portfolio is paying for your $30,000 standard of living, or your $750,000 portfolio is paying for your $70,000 standard of living, you don't have to work anymore, and y'all can spend the rest of your lives together, hanging out together, enjoying your time with one another, traveling the world. Ladies who want to be in a relationship with a man that travels the world with them, they can put forth more effort into building a financial life with that person that generates revenue that they don't have to work for, so that you can travel the world, instead of just expecting this guy to break his back every day and then send you all over the world, because he's got to go to work. He can't travel the world with you because he's got a job in order to maintain that standard of living for you. You know, practical decisions. That's what we need to be working on. Now, we told you guys that a 30-year mortgage is the key to a better life. That's what we were told. And now that you know that the key often lacks certain locks, that you will find yourself stuck in a system designed to enrich a lender first instead of the borrower. By me giving you information that you can utilize to magnify your borrowing power, because loans can turn you profits as the borrower if you invest them correctly. The knowledge that I give you allows you to recognize that the amortization schedules that originally are given to you in the initial contract is stacked against you, and the cycle of moving and getting new loans can keep you trapped in the most expensive years of home ownership every time you change it over again. But you're not powerless. You don't have to just go along with the flow and charge that as the cost of doing business. You now have the playbook, and you have to understand those traps to utilize this playbook to your advantage that helps you have the ability to escape these plans. And from something as simple as rounding up your payments to more advanced strategies, there are clear, actionable paths to freedom. Home ownership should be about security and building wealth, not a financial ball and chain. And you now have the knowledge the banks would rather you didn't have. Now, the choice of what you do with it is clearly up to you. And it is time to stop just renting money or renting houses and start truly owning your own home and owning your own future. So if tonight's show opened your eyes, I want to make sure that you guys hit the like button and make sure that you tell the algorithm that more people need to see this. You want to share this with somebody that you know that needs to use it. One more thing we did talk about today, I want to make sure that y'all remember that we talked about how XRP is not what they say it is. They are not about to back XRP with gold, and gold is not going to $25,000. We've proven that with all the information from today. Be sure that you guys take the opportunity to hit that notification button on future shows that I'm going to be posting after the show today, because we are going to provide you with more content that breaks down the financial systems that are holding you back and then block. Okay, so now I see your mic, but I got to see you. Can you unlock your turn on your screen here, because you got to be over the age of 18 to get up onto the show. But I appreciate you diving in. Because of YouTube policies, I have to put adults onto the show. But we're also going to make sure that we debunk a lot of the myths and the legends that are around all of those individuals that provide us with stuff. I can't even call it facts, stuff that we tend to try to take seriously. And I want to debunk those myths and provide you guys with more factual information that will allow you guys to make more informed decisions. Now, one of the things I am going to tell you guys is that on a regular basis, you can ask the Google lady. You guys can take it upon yourself to Google it. Hey Siri, hey Cortana, hey Bixby. That's the ceiling, that's the wall, that's the curtains. And then you're capable of making informed decisions where you can know exactly what you want to do and where you want to do it, which allows you to be able to be more informed in your decisions. Now, I want to hear from you guys. Which strategies are you going to use first? Make sure that you guys take the opportunity to think about it and then put it into the comment section. Let's start a conversation that helps each one of you on your journey to success. And if you guys are ready for the next step, well, that looks like you are feeding your snake, turtle, rat thing. Is that a gerbil? Is that a crab? You got crabs? Is that roaches? So wait, you got roaches, crabs, turtles, sharks. He's got all kind of stuff in this tank over here. Is that a piranha bed that you got going on over there? Jesus Christ, Mr. Satellite. You got a whole aquarium. And that's a soft shell crab. Yeah. All right. All right. Special shout out to Mr. Satellite showing me his soft shell crab, his sharks, his piranha bed, a snake that looks like it's eating the gerbil. His poor gerbil. I don't know why he put the gerbil in there with the snake, but the gerbil's being eaten now. Yeah, I'm giving you guys play-by-play. Now, if you guys are ready for the next step, make sure that you guys check out the videos that we're going to have, because tomorrow is going to be our questions and comments from the fans. And you guys will be able to ask appropriately designed questions that'll help us with improving ourselves and improving our decision making. And then make sure that you guys remember that I will help you guys with details on how to build wealth outside of your home, so that you are not in a situation where you're just simply debt free. You will also be truly financially independent and self-sufficient, self-sustainable, which is far more beneficial than just getting rid of all of your debt. Now, first thing I'm going to say is, ladies, as long as the situation doesn't make sense, I'm going to keep asking you ladies to make it make sense. So ladies, please make it make sense. And then fellas, I give you guys this information to help you guys become higher value men. So if you guys take the opportunities to utilize this information to make the changes in your life that are inside of your control, and then navigate around the things that you can't, then you can give yourselves a better life. Ladies, this is a male-driven podcast from the male's perspective, but you too can take this information and make yourselves higher individuals. All you have to do is just focus on the things that you know you need to change. Stop doing the things in 2024 that wasn't working for you. Stop doing the things in 2025 that wasn't working for you. And start finding things in 2026 that will be better for you. I want to say I appreciate you guys for coming to the show. Special shout out to Mr. Satellite. Thank you guys for coming to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. And I will see you guys tomorrow night.
Chase validation, now I validate myself. Building inner strength, putting doubt upon the shelf. No more unnecessary drama, no more wasted time. Climbing higher, constantly making my own climb. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command.